Welcome back to the channel, everyone. Today I want to talk about the suspension of the Evergrande stock and the incoming default of the Evergrande group. And I also want to talk about a market veteran predicting an 80% correction in the S&P 500 by the end of the year. So stay tuned and let's make some money. But before I dive into the video, if you haven't already, be sure to sign up to Moomoo using the special Thomas James investing promotion. Not only do you get a free stock worth up to $350, and not only do you get a second free stock with a guaranteed value of $50, but you also get a third free stock with another guaranteed value of $30 on top of that. That's at least $80 in guaranteed free stocks just for signing up to Moomoo and depositing at least $100. You can always sell those free shares and get at least 2 entirely free shares of AMC just for signing up and depositing. Link in the description below. And now I want to dive straight in with the key information. So, goodbye $426 trillion derivatives market. To those wondering, sure, they're not 100% negative fair value yet, but the majority are rehypothecations of rubbish with much less positive fair value than stated. When markets crash, so does the positive fair value of derivatives, thus equalising realised losses. As Bloomberg tweeted saying latest, shares in China Evergrande and its property management unit were suspended from trading on Monday as a fresh debt test loomed for the developer, underscoring broader risks that have left credit markets on edge. Now, in my video the other day, I noted that Boss Blunt had updated his due diligence on the derivatives market. When you include the holding companies of those top 25 financial institutions, the total derivatives market is worth $426 trillion. A lot of that is held in put and call options. Obviously, you've also got other kinds of derivatives like interest rate swaps, other forms of swaps, forward contracts, and more, but a lot of it is held in options. Now, obviously, when a market crashes, the fair value of those options is going to go way out of whack and is going to also crash massively. And therefore, the $426 trillion derivatives market is going to be basically worthless. At that point, and when those options expire, unrealised losses turn into realised losses. FX Hedge also tweeted saying China Evergrande default expected to be the biggest ever, and therefore also bigger than Lehman in 2008. Therefore, this is going to have a massive impact not only on Chinese property developers, but also on Chinese financial institutions and banks, and that impact is also going to be felt worldwide, even in US and UK markets as well. Because obviously US and UK financial institutions and banks also have massive interest in China, and even specifically in this Evergrande debt. Creditors have also said that Evergrande is on the hook for a $260 million jumbo fortune note due October 3rd. And interestingly, this note or this bond has a 5-day grace period and not a 30-day grace period for payment until default. And therefore, by October 8th, we will know for sure whether Evergrande is about to default. Now, I personally think it's very unlikely that Evergrande will be able to make this bond payment. They've missed the last 3 over the last 2 weeks, and they also can't even afford to pay staff or suppliers. They've already sold off as much inventory and assets as they can, and still yet don't have enough cash to make these bond repayments. Potentially the CCP could bail them out. If they do, it's only likely that they'll bail out the onshore bonds and not the offshore bonds. And considering the Evergrande stock has been suspended, it sounds like to me they won't be making this note repayment. And on top of that, Evergrande isn't the only stock that's currently suspended in the Hong Kong market. You've also got Xinjiang Maojin Group, you've got GTI Holdings, you've got China Boza Development, China Supply Chain, Million Stars, iCable Communications, Dragon Crown Group, Evergrande, Evergrande Services, and Hobson Development. As you can see, there's a very large number of development companies or supply chain companies or cable related companies. Basically anything to do with property development in China is severely underwater and are all going into default. Now we've got some updated Bank of America information as well. Bank of America's latest earnings show they lost $58 billion in the first 2 quarters of 2021 in their trading derivatives and liabilities and assets portions. That's bad. That's very bad. Obviously, they're also the clearinghouse for 97% of all Citadel securities' trades, and it's also the margin holder for Citadel as well. Therefore, Citadel have borrowed all of their money from Bank of America. Not sure to what extent, but in 2008 the banks failed with a leverage of 35 to 1. Right now, from what I can tell, most institutions are leveraged somewhere in the range of 75 to 200 to 1. Now these leverage ratios are to do with the leverage between derivatives and assets. Obviously in the clip that I've played you from The Big Short, back then, credit default swaps and synthetic CDOs were in the ratio of 50 to 1 on the underlying bonds. Right now, from what Corey can tell, banks are currently leveraged in the ratio from 75 to 1 to 200 to 1 on that same assets to derivatives ratio. Just quickly rewinding a little bit here to Citadel, we know that Citadel are leveraged in the ratio of 7.1 to 1 all the way to 8 to 1, and therefore all of that cash is being borrowed directly from Bank of America. Obviously, Citadel have something like $35 billion in equity of their own, and they've borrowed the additional $200 billion to make up that $235 billion asset position. All of that cash has been borrowed from Bank of America. Let's add to this that over half of the brick and mortar locations for Bank of America are still closed with signs on them that have instructions telling you how to access any safety deposit boxes you may have there. And a large number also state on the doors that they will not be reopening, and they issued a $15 billion bond in April to raise cash. I haven't even yet begun to read the Pandora Papers, which were released on the derivatives world. The derivatives world is worth hundreds of trillions of dollars, and it's all basically promised money that doesn't exist. And if you do want to read more on the Pandora Papers, I'll leave the link to this Twitter thread and this link here down in the description below as well. Also on top of this, Bank of America also recently filed a shelf to offer up to $123 billion in debt and equity securities over time. Bank of America's market cap is currently $362 billion, and therefore that's an offer that would dilute the stock by a whopping 33%. Now obviously this article is back from August, but it's still relevant right now, and if anything, even more relevant right now to what's going on with Bank of America. Bank of America filed a shelf registration on Monday, which is obviously going to be back in August, with the SEC to allow it to issue up to $123 billion in debt securities, warrants, preferred stock and equity securities over time. Proceeds of any offerings will be used for working capital, to fund investment in or credit to subsidiaries, to repay debt, to invest in other businesses, and for general corporate purposes. So I guess I am going to be picky here and pick specific words, but Bank of America are issuing up to $123 billion in equity and stock for working capital because they basically don't have enough cash to meet day-to-day needs. So I guess what is a shelf offering? And a shelf offering is an SEC provision that allows an equity issuer, such as a corporation or bank, to register a new issue of securities without having to sell the entire issue at once. So instead of making one giant share issue that dilutes the stock at 33% all at once, they can issue it in separate little stages whenever they like. The issuer can instead sell portions of the issue over a 3-year period without re-registering the security or incurring penalties. This lets a company adjust the timing of the sale of a new issue to take advantage of more favourable or less favourable market conditions should they arise in the future. So basically, Bank of America made a secret provision a little while ago that if everything does hit the fan, they can issue $123 billion of new equity and get $123 billion of cash on a whim's notice whenever they like. The company maintains any unissued shares as treasury stock, where they remain secretly on the shelf until offered for public sale. So instead of needing a government bailout, or instead of needing to spend months and months on all the complex paperwork that comes with a share issue, they've basically already got it, and they've got it on the shelf, so they can issue all of this new equity straight away in an emergency. Now, a 48-year market vet says, "I think we're heading for disaster," and he warns that inflation will be more persistent than expected and force the Fed to pull money out of the system, and says stocks will crash at least 65% by the end of the year as a result. Now obviously this was written on June 26th, and as of yesterday he's just updated his estimate to not a 65% crash but an 80% crash. That article is on Business Insider. Unfortunately, I don't have their premium subscription, so I can't read you that updated story, but this is the exact same story just a few months ago. Instead of being an 80% crash, at this point he reckoned only a 65% crash. So basically, just imagine this article replicated as of yesterday, but made even worse. David Hunter is warning that stocks will top in the months ahead, before falling at least 65%, or updated, stocks have topped and are now about to fall 80%. Hunter said that inflation will be less transitory than the Fed expects, and this will result in the central bank pulling liquidity from markets. So this David Hunter is the chief macro strategist at Contrarian Macro Advisors. And so far his predictions have remained generally on track as well, therefore he clearly knows what he's talking about. In December, for example, when the S&P 500 set around $3,700, which was then all-time high levels, at that point Hunter said that he expected the index to surge to $4,500 towards the middle of 2021. Now obviously that article was written back in June and his target of $4,500 didn't quite come to fruition. It was at $4,200, which is still very close. But interestingly, in September, we hit an all-time high of $4,536 on the S&P 500. Therefore, he was very, very accurate. He also predicted earlier this year that yields on 10-year Treasury notes would drop to around 1.2%, after jumping more than 80 basis points to 1.73% from January to March. And if we have a look at that 10-year Treasury note, it jumped to 1.745% and then fell to a low of 1.175%, so very, very close to 1.2%. And the article goes on to say, but now is where Hunter's predictions get interesting. And he has said and reiterated this week, obviously back in June, that he believes the S&P 500 will top in around July or August, mere weeks from now, which it did, it topped in August. The topping process may appear benign at first, as stocks may test their highs again after peaking, but as the fall approaches, he said, stocks will begin their descent towards a 65 to 80% drop from around $4,500 levels. Hunter said the catalyst for such a catastrophic decline would be inflation, and therefore it seems like so far his predictions have been very, very accurate, so he could be on track for a massive 80% S&P 500 market correction. Guys, be sure to let me know down in the comments below what you think about the Evergrande stock being suspended and what you think about the S&P 500 potentially falling by 80%. And while you're down there, be sure to sign up to Moomoo using the special Thomas James investing promotion to get 3 free stocks. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.